All right. Good evening, ladies and gentlemen. Welcome to the Ask Me Anything with FSMOne Research Team. This webinar is brought to you by FSMOne Malaysia. My name is It Hong, and I'm from the Client Investment Specialist team, and I will be your moderator for tonight. Okay, so tonight we have two research analysts joining us today. A handsome gentleman, Alvin, and also a very beautiful lady, Jane. Okay, so before we start, right, let's get them to introduce themselves to our viewers. All right, maybe you can start with Alvin.
Yeah, thanks It Hong. Thanks for such a very good compliment. And so my name's Alvin, and I'm the research analyst for FSMOne Malaysia. So for those guys who don't know, part of our daily job scope includes writing articles that you can see it in our platform, and then also doing presentations and also doing those shooting reels like you can see it on our Instagram page, and then also meeting fund houses, meeting those fund managers to ask them about their strategies or investment outlooks. Yeah.
Yep, that's good. So Jane, you are the only female research analyst from our research team, right? Would you like to introduce yourself to our viewers here?
So hi, this is Jane from our research team as well. So generally, we answer to a lot of queries. Just like today, we actually has this session for you to ask anything that actually comes to the top of your mind. When it comes to investing, definitely we face a lot of struggles, and sometimes there are a lot of confusion when we a lot of noises in the market. So we are here to actually convince you and not to confuse you. So just feel free to drop your question in the Q&A on chat box over there. So we'll try our best to answer your question with honest opinion.
Yeah, that's very good. So actually we don't, should never get blinded by their good looks here, because they are very good at doing their job. So they have been researching the market, and then, they have shoot a lot of videos promoting the investment strategies to our investors. And also, I believe Alvin and Jane, right, they are no strangers to our followers. They have been shooting a lot of Instagram reels and then posting into our social media platforms, right? Okay, so before we get into the discussion, right, I believe we have our viewers right here, over there. They have, registered for this webinar because they have experienced some pain points, some pain points that bring struggles to them, to plan out their investment strategies, right? So since we have two of our research analysts over here, right? Even for us, three of us, we are actually just like you guys. We are considered as retail investors. So Alvin, have you ever encountered any pain points when you are planning for your own personal investments?
Yeah, definitely. Yeah, so before I am actually an analyst, right, I'm an investor of my own, then some of the major questions that I face is I don't get the help that I need when it comes to investment, especially because we need to admit that what we have learned from school, the theory, and what we are doing actually when it comes to investment is two completely different things. So the theory that you learn from school is actually very, very surface, very basic. But when you put your real money inside the market and see what happens, anything could happen. And some of the time, right? Some of the times, certain scenarios happen that defies the theory that you learn from school. So the most important thing is that I need that time is assistance. Someone to tell me what to do. Someone to tell me what have I done wrong. Yeah, so that's the main struggle that I face when it comes to investing.
Yes, correct. Even I believe some of our viewers out there, right, they are also experiencing the same issues here, right? Because we'll never know which sources news, right, they are actually the most accurate one that you can actually make use of it for you to plan out your investment strategies, right? Yeah, I think that's a very valid point. What about you, Jane? Do you have any interesting stories that you wish to share with our viewers today?
Definitely, if you practically put your money in the stock market or bond market, you understand there are a lot of interesting but painful stories. So generally, there are a lot of noises in the market, just like what we witnessed in the turbulence of the market recently, especially in the last quarter, that from Japan to tech and back to Malaysia. So these kind of noises will actually be reflected in the news headlines as well. So this might as well at some point of time being exaggerated, or some are actually being a little bit biased. So you may not actually get what of it are actually facts and how many of them are actually opinions. So we should actually draw a clear line over here, and we should have the ability to actually differentiate. So these are, I believe, are some of the struggles that I actually face as an investor. Yeah.
Yes, correct. A lot of biased opinions coming from the, any kind of source, So those are the bias that will actually affect us, bring some struggles to us, make the right decisions. Yeah, so again, a very valid point over here. And I believe for you guys, because you guys have registered for this webinar, right? So these are also some of the pain points that we wish to, assist you to solve it for you. So it will make it easier for you to plan out your investment strategies for the coming year 2025. Okay, so yeah. Okay, as of now, right, we are actually in the last quarter of 2024, and frankly speaking, right, I believe even for our research team, right, you guys are quite busy to keep up and follow up with all those market changes. And to be honest, the year 2024 has a lot of things happening around, coming from the political tensions, like from the war in the Middle Eastern area, right? So these are some of the changes that we are looking into, and also we are trying to provide some insights for our investors. So from our Google Forms that we have published earlier on, and we definitely received a lot of good questions from you guys. So we are excited to address all these questions, and I'll try my best as a moderator here to squeeze out as much juice from our research analyst over here. All right. So one of the burning questions. Are you guys ready for it?
Yeah, let's keep it rolling.
Really? Always ready, right? All right. Good. So the first thing, let's get into the US market. So as we all know, US market has been performing really, really good in the past few years, right? Since the Federal Reserve, they raised their interest rates, right? So now looking at the fact that, Federal Reserve, they have started to cut their rates, 50 basis point, right? Is there any effect that we can see from the market? Because previously the market has been able to tank, right, when the Federal Reserve actually cut their rates. So is it going to be the same scenario that we're looking at right now?
Yeah, I think that happens quite a lot. A lot of questions that I gather from different investors. Also, the narrative was saying, oh, if I look at the back historically, when Fed cuts rates, market tends to go into a recession. But that's a really first point that you need to ask yourself is, what happens first? Is it the recession first and then Fed cut rates, or actually Fed cut rates after, then it followed by a recession? So if we look back in the past, right, in 2008, the subprime mortgage crisis, actually the Fed cut rate at around 2007, it's at around October. So, but then at August that time, at 2007 August, the Bastons will actually show some difficulties already. Some of them have begun to fail already. So that's the cut rates was coming after the Bastons fall. But in in the year 2000, during the dot-com bubble, right? So markets were actually started to fall during the year 2000 January, but then Fed only cuts rate at around March. So we need to know, but this time that's a little bit different because now, given market is still very resilient, labor still strong, GDP growth still very, very strong as well, but Fed has started to move ahead already because Fed has learned from the past experience. They have started to react upfront, but even that, I wouldn't say that we are out of the recession narrative already because a 50 basis point cut now we are saying today give us the interest rate at around 5%. 5% is still high. It's at 2007 levels. It's still high compared to the past decade. So it's like if I buy something, I buy house or anything at 4 years ago, interest rate was around 0.5%. So current levels is still around 10 times higher than the past. But the more encouraging thing is that we are seeing strong economic growth, retail sales strong, wages growth are strong. The job market, although it is softening, but it's normalizing, it is still strong. Yeah, so maybe Jane, do you have any idea as to how many cuts can we expect moving forward in 2024?
That's a good question.
So yeah, very interesting. So what we actually observe ever since 2023, when everyone is actually building up their expectation for an aggressive rate cutting cycle this year. So this should be the theme this year, but it does not really play out. So from the beginning of the year, when everyone expecting 6 rate cuts and a lot of on easing pressures, that should take place because of after a prolonged cycle of rate hiking, but eventually everyone is actually repricing or actually try to tone down a little bit. That is much more in line with what Fed actually deliver, as what we have seen in September, just that it comes in a bigger size. So at this moment, we actually see more clear and more clarity from the Fed already. Just like recently, if you recall, if you are closely monitoring the market, you may actually notice that in the Jackson Hole Symposium, Fed actually delivered a very dovish remark as what market has already interpreted. That is, they actually say that the time has come for policy to adjust. And eventually they does actually deliver their promise. So by the end of year, the terminal rate, as you look at the economic projection by the Fed, currently actually stands at, should suggest at around 50 basis point cuts. So similarly, we do see Fed actually gives us a very strong signal that while Powell say there's no hurry because they believe that labor market is still rather soft, and inflation, while tipping down, a lot of Middle East conflict or the port strikes that is happening in US currently. So inflation should not actually ease substantially. Hence, at this moment, the Fed is giving more clarity. So the market doesn't have to play the guessing game anymore. You actually can interpret directly from what Fed will actually deliver in their speeches as well as their summary of opinions. Yeah.
All right, that's a very clear explanation over here. So since you guys are saying that the interest rate is actually going towards a very healthy direction, right? So can we actually expect something like, there's probably no recession in the US market?
I wouldn't say so. I wish I had a crystal ball to tell me whether or not there will be a recession to hit us in the coming days or months or even years ahead. But what are we currently seeing here is that a much more convincing standpoint where we have a very, very resilient market. Job market, although it is showing some signs of a slowdown, but it still remains robust. It is still higher. Unemployment rate, although it is soft, it is going up, but it's still considered low compared to the past. And then if we were to take a look at the reports, some of the reports from the Bank of America, right, it was showing that the wages is actually going up. People are earning more and more money. Wages growth are very, very positive, which could continue to support the market from going bad further. Yeah.
I see.
So yeah, on this note, right, maybe I add some color on the recession part. So when you think about recession, it's not just simply the broad market or US economy tank and suffered in a dire situation. Also, some people actually cite it to earnings recession. So if you look at sector, a lot of people may say that, is it now actually we see a sector rotation from tech to the other one and to defensive to cyclicals? Yes, indeed, if you pay attention to earnings performance of the US market, right, you do see a broadening of earnings growth already, not just simply concentrated in tech space alone. So in healthcare, in consumer, in utilities, you do see the earnings actually pick up. And just simply say, all the sectors in the US actually has already many of them actually escaped earnings recession already, with just a few, perhaps the very volatile one, those subject to commodity prices a lot. For instance, materials, oil and gas, they may still suffer single-digit negative growth, but indeed they actually will receive some boost from the policy support in this upcoming election. Maybe we can explain it furthermore.
I see.
Yeah, so I think moving forward, there will be going to be very data dependent. Even on the earnings side or on the economic front, whether or not further signs of slowdown will show ahead. And if that's happened, that will really push towards a possible technical or maybe a real recession. But I think it's at current standpoint, we are safe, right? Also on the earnings front, we are safe, yeah.
I see. All right, so meaning to say US is still a good time to buy?
It is.
It is. All right. I mean, from the perspective of diversification, I believe US market is still considered a very resilient market, right? All right. So meaning to say, I would say that since I'm kind of summarizing up what you guys have just mentioned, right? Is that US market is still resilient, and then also the corporate earnings, they are still performing, right? Giving out a very good performance to the investors. So it's still a very good market for us to look into. Okay. So speaking about technology, right? Again, from the narrative of the US market, right? Since we're discussing about the US market, technology has been one of the biggest, weightage in the US market itself. So Right now, we are seeing that there's a lot of volatility. Previously, the sector has been performing very well. But right now, we are we're actually seeing a very huge volatility from the sector itself. So, do you guys have any comments on it? Whether is it still, presenting a lucrative opportunity for investors to further accumulate?
I think by nature, right, when you invest in technology, you are someone who actually should expect some volatility, especially as relative to the rest of the sectors, because by nature it actually experiences a lot of cycles up and down. Especially in semiconductor cells, you can see the chart is actually as a healthy up cycle, and also it suffers some time of down cycle when the inventory is being is depleted and actually everyone is consuming. So at this moment, we see this tech rally is actually fueled by the AI expectation. And when you talk about AI, it's not only the one on the upstream who actually develop and start all this AI R&D process. You also can look across the value chain, where by stages you do see a lot other sectors actually adopt AI as well in their operation in order to increase their efficiency, while some of them actually use it to actually boost the sales by, for instance, for ads or for instance in their automation. So in this instance, right, you see the ups and downs because a lot of tech rally is actually led by those big techs. And big tech here we refer to those very common names that you can actually see across many funds. For instance, Nvidia, TSMC, Alphabet, and the rest of Magnificent Seven. And these names are usually being cited price for perfection, means their valuation is being perceived at a high level. But I do not think this is a very a scary point where you should not actually take an exposure in tech, because while being priced being priced for perfection, their earnings actually justify. So you still see double-digit earnings growth, and their management guidance is very positive, while at the same time their innovative pace is not slowing down significantly. Maybe Elwin, you have a different take?
Yeah, maybe I actually agree with what Jin has mentioned, but maybe I just add on more about the valuation side. So if we compare to where we are now today, if let's say I use S&P as an example, normally how we measure how expensive a market is used forward PE ratio. So the currently for S&P 500, the PE ratio is at around 24. But if we compare to the tech bubble, right, back in the year 2000, the peak of the dot-com bubble, the S&P 500 index is actually trading at a PE ratio of around 31 times.
Wow,
so
31.
yeah,
okay.
So if we compare to like technology leaders alone, that means tech leaders, now today our tech leaders refer to the Magnificent Seven, which I think most of you heard it or know it already. So and then compared to the back, right, at the past, right, in the peak of the year 2000, the technology leaders were referring to the four horsemen, which is your HP, your Dell, Cisco, and Microsoft. So our technology leaders today is actually trading at around 34 times PE, but the technology leaders back in the peak of the dot-com bubble is trading at around 85 times PE. That's like around times. two or three more times compared to where we are today. So currently, today's valuation for the tech PE is actually much more fair, I would say. And then, so definitely it shows that we are not yet in a bubble yet, and all those expectations are actually supported by strong and real earnings growth for the technology sector.
I see. It sounds promising to our investors, right? Definitely. All the companies, they are still performing well. But I remember previously our call, right? I mean, our recommendations for our investors is that we should focus more on the large cap companies, right? Technology companies. So right now, are we still focusing on the large cap companies, or should we actually diverse a little bit into the smaller, mid to small caps companies? Perhaps you guys can shed some light on this.
I think for us, right, because previously, why we like big caps, because they have much more resilient earnings. So our expectation is that rates, they are likely to be higher for longer, even though few more cuts happening this year and next year, the rates are going to end up higher for longer compared to the past. So in this higher interest rate environment, it is safe. It's much more safer to go hard against those bigger companies which are much more have stronger cash flow, more resilient earnings, and lower debt, because they are big in size. So they can raise more capital at a lower cost. So higher debt cost wouldn't have such a huge impact compared to the smaller companies. But nowadays, if you pay attention to a stock market, right, you may see a broadening of the stock market whereby you see S&P 500 companies actually outperforming the Nasdaq alone. So you see market started to broaden out, searching for opportunities outside technology itself. But that doesn't mean that tech is not attractive, because just now we have mentioned we are seeing catalysts still happening, but then maybe a broadening out of the market. So, but then they are still also going into bigger caps first. So larger companies first. So you can see smaller caps is still slightly lagging behind bigger caps in recent days. But there's a possibility for small caps to actually play a tactical catch-up, but that's a very tactical play, I would say. But if we expand towards the middle to longer term view, our view is still big caps are going to perform.
Right?
Yeah, I think partly answer some of the. I saw one where someone actually asking the Q&A whereby not in a bubble yet, but a bubble soon. So this soon. One, right?
That's a very interesting one. Yeah.
I guess this is generally if like official answer would be a lot of uncertainty ahead, and then Fed is still coming soon, and US election and whatnot. But this one, right, if you look at the general market, those who are we understand the stakes for tech currently is very high by just looking at the amounts that buy into it as well as the valuation level. But we do see general market is still rather rational. They won't like just overreact because of certain bad news that hit certain companies in a negative way. So they will actually readjust, and the market generally recover quite quickly after the panic sell-off. Let's say some of the sell-off are actually triggered by events that are not directly related to tech. Some of it are because of general market weakness or the market knee-jerk reaction because of a very soft labor data that should actually prompt the Fed to cut rate in an urgent manner. So these are the factors that you should actually filter out. Should understand like what are the direct factor that is affecting the tech performance and what is actually affecting the broader market sentiment. Yeah, so this should be something that you should actually closely monitor if you are investing in this space itself. Yeah.
I see. Yeah,
so maybe Yit Hong, you are dealing with customers on a day-to-day basis, right?
Yes.
You know what are customers investing in, what are their major concerns, right? So do you see like customers actually, our clients, investors actually started to positioning themselves towards more conservative? Do they like hold more cash recently?
Yeah, definitely. Because recently, right now, what some of our clients actually feedback to me, saying that again, because we are at the technological and US market discussion here, right? So some of our clients actually, asking about the currency risk that they are actually facing, you know, because
understand.
Honestly speaking, right, the currency has dropped from previously it was like about $1 can exchange up to about 4.7 ringgit Malaysia, right? But right now it's about 4.1 something.
Yeah, something there.
Yeah. So it's like a very big concern for them because they have put their money into the US market, but right now, even the currency losses has already wiped off their profit, right? Profit from the market itself. So that's something that we are actually, trying to figure out. Perhaps you guys can also shed some light for our investors about the currency movement and also some of our views. If it's, good to,
yeah, I get it. I mean, when it comes to investing overseas, there's one risk that we kind of always, all the time, as an investor, is more likely to ignore it. That is the currency risk, because most of the time, like this time, Malaysia appreciate against US dollar for around 15% already for the past few months. So it's very drastic. So it affects a lot of your performance. Like if the performance drop like 15% for currency risk, and then you gain like maybe your US investment gets you like maybe 5 or 6% return, you'll end up at a net loss. So this a lot of investors actually suffered because of that. So I think moving forward, right, although our view is still that Malaysian ringgit is going to be stronger, it's going to be strong, it has been strong, but moving forward, it will be more volatile, I would say, because in the past, why Malaysia ringgit strengthened so much because of first of it FDI that has been coming in, and then also you have a lot of people. Our Prime Minister has been encouraging funds, big local, the state funds to come back into Malaysia, reinvest into Malaysia, and then also we have companies, a lot of companies that does exports back in the past, right? When US dollar was actually rising, appreciating, people were like more likely to hold their profits in US dollar and not converting back. So we are now seeing a wave of conversion from their US dollar profits back to Malaysia ringgit. So you see a spike in Malaysia, the demand for Malaysia ringgit. So you see a huge appreciation over here. So so that's why moving forward, I would say there will be more volatility when it comes to currency risk. So maybe Jane, you can teach us how can we manage this currency risk volatility.
Okay, generally, so when you deal with investment overseas, right, you should already factor in the forex risk, especially when, for instance, just in this case, it's US dollar. So if you are positive in US dollar, definitely when you are investing overseas, you should expect to gain both from capital appreciation of your investment, including some upside potential in the currency itself. But in this case, if the opposite happens, you should actually be alert as well, because some of the trigger point could come as, for this time, we see the main strength is because the Fed actually finally moved and they adjust their policy, and hence the entire narrative is bringing the capital back to Asian country or outside of US, just like what Alvin has already mentioned. So you should actually closely monitor if you actually has a huge or significant exposure in overseas investment. So Japanese yen actually play out as well the same story, where Japanese yen strengthened.
That's something that will be tapped into it later. That's the topic for later. Alright.
So the general approach here is that you may actually adopt a hedge class if you are investing in unit trust. So actually protect you from actually suffer from any currency fluctuation. Otherwise, if you are a person who have high conviction in certain currency, let's say you believe MY will do much better than the rest of the respective currency, perhaps you should adopt a non-hedge exposure as well.
Yes, correct. Non-hedge will be a place where you can actually protect yourself from any currency movement, which we will actually get into it later on. Alright, so be patient with us a little bit. And also, I do see there's a lot of questions coming in asking about a specific country, which we are not going to discuss about it now, but we will leave it for later. It starts with C, okay? But alright, so before we get closer to our home, right, there's another region that, it has been quite unpopular among our investors. You get what I mean, right? So the European market. Yeah. So from what some of our investors actually say, European market is actually a boring market. Yeah. Because the movement and all is not a lot. Definitely our investors are looking for something that is more exciting, can perform better. But European market though, it's like they are kind of constant, giving a constant performance, right? Is there any interesting things that are happening in European market, or is there any things that we can expect from European market?
I think European, right, the European market is like an underdog, I would say. It tends to get overlooked by many of the investors almost all of the time. People will just go to US or global tech instead of going to Europe. But one interesting here I would like to share about Europe is that we need to look at European market very differently from their stock market. Because you can see, back in the past, European economic growth isn't good, I would say. Manufacturing is down, economic growth is slow, but then your stock market keeps hitting higher and higher again.
Yep.
Yeah, so this thing we need to know is that this has caused a lot of confusion among investors also. So what we need to know is that actually the stock market in the European, right, they are actually most heavy weighted in like healthcare or an industrial's name. And these companies, they actually do most of it is, they are global companies. They do most exports, not just target at European consumers itself. So you need to look at these two parts very, very differently. So if, like just now I mentioned, European markets now currently heaviest weighted in like healthcare. So all these drug makers name like your Novo Nordisk and all. And then you have also industrials, those big car manufacturers. But on the other side, although there are some, they are doing good, all those for like those drug makers, right? But on the other side, there are some risks underlying also, like political risk is some risk that has been brewing in the European market. If you pay attention to some of the election that happens recently, rather France or some of the state election in Germany, you see there's a rising power of the right wing. So right wing party has actually gained more and more traction in the European side. So this can be good and can be bad at the same time, because in this world where geopolitical tensions are going to be rising and rising, right? If let's say the right wing takes over, there's a risk that they want to break off European market, but that's a far thing to say. That there's still not going to happen in the near term. But I just want to say that the right wing party, they are more like populists. They want to focus more on their own country first, rather than as a whole group of European country. The European Union. So these are one of the risks that investors need to take account, because the political risk is there. And then also you have also the slowdown in China, because the trade of Europe market with China, it has very close proximity, close ties. So if China slows down, right, your exports are going to slow also. Yeah.
Oh, speaking about China market, right? Because recently the European markets, right, they have been imposing some tariffs onto Chinese goods, right? Is there any, because definitely it's kind of like interlinked between European market and Chinese market, right? So if let's say they're imposing this tariff, right, do you think that it will bring some negative effects towards the European markets in terms of their performance?
I think if everyone could recall, the most scary one would be the one on EV.
Oh my goodness, that's the worst.
Chinese EV is one word cheap, and recently they just report their sales from their local EV players is rather impressive. So even though China is experiencing somehow a downturn and for a prolonged period already, but we do see the local demand for EV cars actually rising, and it's not actually showing any signs of softness. Because one thing is a policy incentive that actually encourage people to actually use EV on the road, and other thing is that because of the price, and the availability of the facility that is supportive of EV consumption, and with these tariffs imposing on in the Europe market for EV imports from China especially, we do see that generally the consumption of EV in the Europe or in the Western country is still relatively low if you compare side to China. So generally we don't really see this being to impose much of a huge impact towards Chinese EV players, because their bread and butter still belongs to their home market. Yeah, they do have a strong consumption locally, and this tariff overseas purely will actually, because they do the European people do this because in favor of their own players, but some of the automakers in European actually they cease or they actually express their view to actually do not really invest heavily in EV production already. So this also indirectly telling us that EV consumption in Europe may not actually bloated extensively, just like what you see in China. So this impact may actually be negligible. Yeah.
I see. So meaning to say European market right now, definitely there's still some risks on it, but at the same time we are also seeing that there's also some potentials for our investors, perhaps, right?
Yeah, so I think overall, right, when it comes to investing in European markets, given all of the risks taken into also the potential when it comes to investing in Europe, I would say it's rather like a 50-50. So investors who really want to take their positions into European market will really need to balance out the risks and opportunities and rewards. So I would say when it comes to our investment call for Europe, right, we're actually much more neutral in stance.
Yeah, should be more selective in Euro market. So you can just look at a few sectors that actually receive very good policy support. For instance, the renewables, the capital intensive sectors, especially healthcare, because they are usually the one leading the innovation and side by side with US companies. So they still have a large part in the World Healthcare Index. Yeah.
Yeah, that's a very clear direction again for investors. So if you guys are actually looking into European market, I would say to summarize things up, just put some exposure into it. If let's say you have additional capital, you can actually look into the European market, and also always manage the weightage of European market in your portfolio, right? Okay, so actually we are getting a bit closer again to our home, Let's talk about Asia ex-Japan region, all right? So the main concerns that we are looking at is that the political tensions between China and US, right? So that's actually one of the biggest concerns that a lot of big companies they are having right now. They are concerning that their businesses might get affected by the tensions. So they are actually looking for some alternative, isn't it? So Asia ex-Japan region has become one of the best options that they have, right? So right here, is there any specific countries or sectors that we are actually looking at it from the Asia ex-Japan region?
I think maybe I just sum up a few things over here is that first of all, Asia mainly dominated by China and India, right? So,
yes, correct.
Yes, so China experiencing a slowdown and it started to losing market share in the global index. So you can see MSCI Asia Index, China is currently it's around single digit exposure already, close to there already. And then also the next one is India. India is a much more complicated things. India economy is much more driven by their own domestic players. So a lot of funds is actually flowing because they have a big market for their own self. So people were they buy into India because of all of the domestic players and all of the policies introduced by their government, the Prime Minister Modi. So this have successfully prop up the entire market. You see stock markets of India has been very, very good. They're also benefiting from the China plus one strategy. People has high hopes for India. But then at the other hand, I would like to address to you that I think the expectation for India is actually quite slightly on the high side now because and there is chances that they may fail because people are taking them as the China plus one, the next China. They are China in the early days, but then China, they are a manufacturing hub. But for India, right, they want to take over China's title as a manufacturing hub. It will be quite challenging because India now currently they still have intermediate electricity shortages. And if you want to be a manufacturing hub, this can't happen.
Yes,
cannot happen.
Very challenging.
Yes. So I think now at current standpoint, expectations are too high, and then valuations are a bit on the high side also. You see PE ratios for India has been expensive. So for us, we would recommend our investors, if you want to have some positions into India, right, maybe hold a little bit, not too much, consider having single digit exposures toward India in your total portfolio. That would be great. Yeah.
Low exposure,
and then,
right?
Yeah, and then what are some of the opportunities you see in other parts of Asia, Jane?
Yeah, I think maybe in a very brief way that in this geopolitical tension, right, maybe you can pay more attention to the beneficiary of this because given that this is the tension that is being escalating and has already been there for years already, so you should not expect it to actually go away because of someone actually take the helm in US politics or whatever. So it will be there, and China will always be the victim to actually being weaponized or being downplayed in this instance, being targeted.
The biggest target. Right.
Yeah, so everyone should isolate China. So in this instance, right, the beneficiary actually much of it concentrated in the Southeast Asia as well. If you notice, a lot of FDI actually flow into Malaysia, especially with Johor actually currently has a very strategic location and also at a connection with Singapore, the financial hub. So we actually does see that economic zone is building up, and a lot of investment actually coming in towards data centers as well as those building up for consumption in the future when the economies are actually open. So these are some of the opportunity you actually look into. So for instance, Indonesia also stands out in this instance because of the abundance minerals in the land. So allowing both countries, US and China, to tap into to build their supply chain. So this is one thing that you can actually see and happens in the ASEAN countries whereby they actually shift their production or actually try to source better access to certain resources that US used to find in China in other parts of the world.
I think also, right, just now we have been mentioning about technology. gonna be great. Semiconductor sales demand will continue to be high because we have seen a structural driver, structural trend that will push the entire semiconductor demand. So I think this also brings to an opportunity in Asia, especially for our new Asian tigers. Why we came out with this name, the new Asian tigers, because comparing to the Asian tigers in the past, right, the current new Asia tigers are the major beneficiaries of semiconductor wave in Asia. Like first of it, South Korea.
Yeah.
South Korea, we like it pretty much because they are one of the major semiconductor players. They have all those memory players, players in the memory space. And then now, comparing to the past, right, South Korea was more like a manufacturing industrial hub. But today, they are more and more relying on semiconductor sales. Semiconductor sales stood around 20% of the entire South Korea exports. So
I see.
yeah, so if semiconductors demand, the trend is ongoing, is continue to be strong, I think South Korea will be one of major beneficiaries.
Yeah,
and then we
correct.
also have like Singapore. They are also a major player in the downstream of the semiconductor cycle. So when it comes to semiconductor, we have upstream, which is those players that design the semicon, right? And then we have midstream, that those manufacturing the semiconductors, like your TSMC, the Taiwan Semiconductor Manufacturing Hub. And then we have the downstream player that do the assembly and test. So comparing to the other players, the downstream players are much more like, they are less capital intensive, less technology intensive, but they are also they require quite high precision also. So not everyone can do it. So Singapore plays a very, very good major role in here. Other than Malaysia, Malaysia also has a major role.
Yes.
But Singapore is a major role in here. But if you look at the major index in Singapore, the STA index, they hasn't have much more technology players. So when it comes to investing in semiconductor plays in Singapore, right, investors can consider the off benchmark names where such as you have the UMS holding. So it's pretty much off the STI names. And then also the third Asian tiger I'm seeing here is that the potential is that Japan, right? They are one of the major exports. They sell the manufacturing equipment for those downstream players of the semiconductor industry. So I think very less people know, not much people know about this. So they sell all those equipments that you need when it comes to semiconductors in the downstream. So they are the largest player in it. Their market share is even much more bigger than the US when it comes to the semiconductor equipment in the downstream. But when it comes to Japan, right, I know all of us, I think if you have long enough with us, you know about we have been very, very positive on Japan, right?
Yes,
I think a lot of investors have been investing in Japan too, right?
Yes, correct. If you guys remember correctly, right, I mean, if you guys can recall, we have been promoting Japan since the end of year 2022. And then since then, we have been promoting Japan very, very strongly. Right, tapping into Japan market, right? Okay, so definitely we do see that there's a very strong momentum in the Japan market. The Japan market has been delivering a very strong performance until I would say recently they have slowly get into a stagnant position because there's a lot of changes, right? Especially the recent news is that they have changed their prime ministers. Is that right? Yeah, so since each of the, basically all the leaders, they have their own way of managing the countries, right? What do you guys see from this new prime minister? Is there any effects or like any policy stance from him that will actually change the structure in Japan, the economy of Japan?
Okay, I think this is a very very interesting question because ever since this new PM actually win last Friday, the Nikkei futures actually suffered badly, and then on Monday we do see Nikkei itself actually also tanked by around 5%. So what actually drives this sell-off is that because this new PM, the win actually come as a surprise to many. So everyone has already been paying the attention to the popular candidate. Okay, however, it's a female candidate. However, she did not manage to win because this veteran, which in my personal point of view, I find it he has actually outright advantage in this tight presidential race, which is among nine candidates itself. So what actually he is good at is actually first thing first, he is a veteran, also a son of a former prime minister. So at the same time, he is more senior. So in traditional mindset of the Japanese people, they do still stick to this entrenched seniority system. So they still respect the old, and they still expect someone who is more experienced to actually take the helm. So secondly is that he's a better man in managing the relation with foreign parties, while at the same time being someone who is rather hawkish in dealing with monetary policy. So in this instance, right, with this with Ishiba, this new PM taking helm, we do see his view will be much more aligned with BOJ, and collectively this is more supportive for the Japanese yen going forward, because he will indirectly support the rate hike efforts, while he has already expressed his view that in boosting the inflation in Japan is very important by ways of, like, let's say, boost the wage growth, or we actually boost the consumption via more fiscal policy. So these are something that we can actually look into. And for Japanese yen, many of you may have question in mind, is this the end of this, the bull run? We understand that from 160, the extreme level, to currently at around 140 plus. So this is a very good progress. And on the back is because BOJ has expressed several hawkish views that actually fuel the bull run in Japanese yen. And moving forward, BOJ is likely to hold in October in our point of view, which is in line with consensus. But in December, we might actually see BOJ to actually take a second move if, let's say, the broad market actually evolve as expected. Let's say Fed actually deliver their promise to actually cut further, and BOJ actually has a reason to actually jack up their rate again, actually to close the yield differential. So essentially, all these are actually bullish factor for Japanese yen.
I see. Yeah, there you have it. You're getting the first information from our Japan lady over here. She has been posting a lot of content related to the Japan market, right? So after all the explanation over here, do you think Japan is still a good time to buy?
Okay, so for Japan, right, many will find that Japanese currency is a safe haven. As likewise, the Japanese equity should behave in that way as well, which is should treat it as a hedge to tech or to US, which is in the hindsight more volatile. But in currently, Japan dynamic is rather different from what we see in the last decade. They actually experience structural reform in terms of governance or the corporate restructuring, while at the same time they see inflation coming back. So collectively, you might expect Japanese equities to also fluctuate like the rest of the equity market, which is a normal pattern.
Yes.
Yeah, so you shouldn't treat it as something that is super volatile. You should avoid at all costs. Yeah, so Japanese equities are currently, while at the same time it suffers from external uncertainty, locally it has a snap election in place as well. So this is something you should monitor some key risks moving forward. For instance, the policy direction that this new PM is going to address. At the same time, how actually he will initiate his military view, because he has a background in this space as well in the past. Yeah, so these are some of the key risks that you should monitor and expect some short-term volatility in Japanese equity.
Yeah, maybe if you ask me about one word about Japanese, right? Everyone was saying, oh, if Japanese yen appreciate, markets will drop. That's what's happened with the recent movement of the Japanese market as well. But if you ask me, back in the days before the last decade, Japanese had a super boom up until 1990s, right? Interest rate was like 4+%. Why do you think interest rate will stop Japanese equities now, right?
True. So I would say it's probably a good time to buy.
Yeah, because a strengthening currency actually gives you more confidence to actually invest in that market. If let's say the currency keep on weakening over time, so like what's the bright prospect that you should expect from the market, right? So this essentially help to actually shape the sentiment as well in Japanese equities moving forward. Also encourage the local players to actually adopt more innovation or automation in order to achieve cost efficiency, even though when Japanese yen actually gains some momentum.
I see. Sure. I mean, it's a you get it from our Japan lady over here. So Japan still a good time to further accumulate. All right.
Yeah, I think let's maybe just dive right into one of the major topics that I see most of the people are typing in, right?
Yes,
I think you guys
correct.
are also seeing
I
that
was
in
skipping
the
for the
yeah. That's the we leave the best for the last, right?
Yeah. Of course, there's another one coming later, but again, let's get into it. I believe this country is actually something that we need to, be very, very careful with it, which is the China market. Okay, so China market, one of the most asked question is it a good time to buy China again? All right. So I believe that there's a lot of discussions about China happening recently because of their performance. The performance of the China market and also the Hong Kong market has been shooting up like crazy. Okay. So is this and also if let's say you guys are following our articles from our research team, right? We have actually changing our stance for China from negative to neutral, if you notice, right?
Just right before the rally.
Exactly.
Right on time.
Come on, so much accuracy. So in this case, are we gonna maintain our position from changing from negative to neutral? And also, is it a good time to look into China market again?
So China market, right? The rally actually we witnessed because government has started to take it seriously.
Yeah.
So doesn't mean that in the past the stimulus is not effective. Just that at this moment, because the timing is just right. So they are just making it whereby they actually plan it in a way that they release the monetary stimulus. The good news first, let's say the cutting the rate for the reserve ratio and also some of the mortgage rate for the home buying things. So these are the good news that they actually lay ahead. So after that, the government actually step in, or the presidency actually reaffirm that they're gonna pledge more fiscal stimulus to the market. So this actually comes at a rather surprise to the global investor because China has been like a sleeping giant in the past.
Yes,
so
correct.
there are a lot of bad comments actually criticize the government is not doing enough. So at this moment, yes, they are actually releasing more fiscal stimulus, but the root cause of this entire the downturn is actually still lies within the real estate struggle itself. So we are still, my point of view is that we still should wait, have more patience to see more convincing stimulus into this targeted area to actually resolve the burdens of the developers first before we can actually see a strong recovery and a sustained rally in the Chinese equities. So what do you think, Alvin?
Yeah, I think more or less the same issue is there because first of it, the latest stimulus has been targeted to 1, consumption, 2, the property market, and 3, the stock market. So just now, I think Jane also mentioned about the 1 and 2, the consumption and the property. But why property is such a big issue in China is because property is like around 70% of the household, common household wealth. So if let's say, if your property goes down, your entire investment you're willing to spend also goes down. Your willingness to spend. So no matter how much I cut my rates on the loans, on the existing loans, on the second house down payment, if my confidence is bad, I won't buy. And then also if my view is that oh shit, property markets are gonna go, prices are gonna go down, then I won't buy it now. Even if you cut down rates, I still won't buy it because like let's say 15% down payment. If my property price fall like 15%, I burn my entire down payment. So it will induce me to like default on my loans. It will. So another thing is that what we have seen here, I mean, many of you guys might have been seeing that the headline saying that people are spending in China. You can see like the Labor Day, right? A lot of influx in domestic traveling was super crazy. People were all around the roads, right? Number of tourism have reached historical high.
Yes,
but
correct.
There's another picture showing here. If you look at the second quarter report, right? Around 14 listed companies that is related to the resorts, hospitality, those hotels, 9 of them are making losses. Does this mean that actually the news in the headline is scamming us, is
misleading?
Misleading? Yes. No, but it's actually their data is right. People are actually traveling, just that they are there to just experience free sightseeing, go walking around and spend on lower lower fee products, cheaper products, and then stay more cheap on cheaper accommodations. So this actually affects the entire consumption pattern. This is a change in the entire consumption pattern, because another example is that you have, Starbucks. China comes up with their own cheaper version of Starbucks called the Luckin Coffee. And then we have Chaji. Then they also come up with a cheaper one called the Mishe. And then now there are rumors saying that they are coming out with a cheaper version of the Mishe. So it's cheaper of cheaper. So this is an entire change of the willingness of the consumer behavior we are seeing here. And that's really, really hard to reverse in China. But I won't just I'm not here just to bash China. We're actually seeing some of the encouraging point here is that one of the stimulus was actually targeted at the stock market. They were saying that I'll pump 500 billion into a stock market. If not enough, I'll continue to pump. So this shows the conviction of the Chinese top authorities and their determination in propping up the entire stock market. So for us, we think that this will cause some of the short-term relief, short-term tactical play for China. So, but over the longer term, right, I think there are some of the structural issues, like just now I mentioned, remains and relies in the market. So, so my view is that for short term, yes, tactical play, yes, you can. If you are willing to take a risk, you can go into it.
Yeah,
but maintain the be aware of the position, the exposure. Yeah.
I think what I was trying to point out here is also one key risk that China uniquely on, which is the transparency. So generally, when we speak of China, right, a lot of data you may just think of it as being manipulated, and some of the data in reality is being suppressed. For some of the high frequency and very material data for decision making in investment, for instance, the foreign fund flow on a daily basis, or the youth unemployment rate, and some of the statistics that comes under your radar is actually not being published on a timely manner. So these are some of the movement or drastic action that has been taken by the government to actually manage the volatility. Maybe from a good side is that you may see less speculative position already in the Chinese market, which reassures some of the investors who are staying on the sidelines to actually take a tactical position in Chinese equities. But on the other side is the valuation thing, which Alvin has actually touched on a little bit just now. Valuation thing, if you just rely on this single indicator or barometer to actually make up your mind whether or not to invest in China, I think it's too rough already. You should actually look at the fundamental of the economy itself, not just being that the valuation is too cheap and if not now when. So this is not a very good mindset when it comes to investing in China, because one thing is if you want some may think that if you want a safer bet or more defensive play, SOE should come to your mind because it offers high dividend yield and actually it performs quite well this year. But generally for a fundamental change in China, I think we still need patience to actually see more fiscal stimulus being pumped in, because on a standalone basis, 2 trillion at this moment, I don't think this is very sufficient to prop up the whole economy. It needs to be in a serious manner whereby more channels of funds actually coming in to prop up different areas of the economy.
I see, yes. I mean, definitely one thing is that the confidence from the foreign investors and also the policies that, how effective the policy is from the Chinese government, right? So I would say right now is again a tactical play. If let's say you do have some faith in the China market, definitely you can actually allocate some of your capital into it. But if let's say you are being more cautious on it, I believe what we would recommend here is that, just remain your holdings, existing holding, hold on to it, and then wait for a better catalyst, right? All right, I think that's a very good sum up for this China market. But no worry, if there's any follow-up questions that you guys would like to ask to us, we will actually address it in perhaps we will have another article to address all the questions that we collect from you guys here. All right, so I think, because we are kind of running out of time right now, perhaps we can just very, very quickly tap on the Malaysian market.
Yeah, maybe, before we, when it comes to almost the end now right here, maybe just highlight some of the Malaysian markets. I know a lot of people has been asking about small caps. Why are they underperforming large caps? I think one of the main reasons is that because recently we have seen fund flows. We have seen foreign investors actually started to buy in Malaysia stocks.
Yes.
But local retail actually selling off Malaysia stock, So that's the reason why Malaysia's small caps underperform. Because foreign investors, when they come in, big caps will be their first option.
Yeah. Yes.
So
correct.
that's why, and then locals, they are selling. So you see small caps has been underperforming. But on the longer term, just now I think Jane also mentioned about some of the structural catalysts we are seeing for the Malaysian market as a whole. Like those investment in Johor, the investment in Singapore and all, right? So I think that basically, from Singapore, investment from Singapore
Yes,
and all.
correct.
So I think that's basically some part of our view for the Malaysian market. But I mean, before the last, I would like to address one of the question that has been concerning investors around here is that amid all those volatile markets, especially when now you can see Iran, Israel, the war between is escalating. So how can investors better manage the volatility? I think this is one of the questions that has been asked that has been concerning our investors too.
Yes.
So for these geopolitical tensions, right, they actually existed since many years ago already. So recently we see actually Iran actually attack Israel again in a second attempt. So this one comes at a bigger magnitude and a more fierce one. So what can we see from here is that the unrest will not actually cease anytime soon, and the risk that poses actually upside risk to inflation. So we do see that some of the commodities prices, you may see the price to actually swing a little bit this few weeks, but generally on the supply side itself, we also see actually OPEC itself actually cut production until November. So we do see some upside pressure to oil prices, and generally will actually fit into the inflation picture as well. So on this note, right, investor actually should manage in a way that is which side is Iran or Israel aligned to. So simply to put, Israel actually has a close tight relationship with US, and US immediately after the strike, right, actually came out and to say that they will actually support Israel in the retaliation in a more aggressive way. So we do see investor might actually try to monitor this closely, because the oil prices does still matter when it comes to investing, because while it does not really directly affect your portfolio, it actually fit into the inflation, and the inflation itself may actually affect the prospect of certain markets. Yeah.
I see. Oh yeah, we have a question over here. It's actually asking about what is the impact of the war towards the European market. So I believe just now Jane actually explained a little bit about the inflation effect, right? Meaning to say it might actually disrupt the supply of the materials and also any commodities within the European market, right?
Especially European market is very capital intensive. Also, they rely highly on these fossil fuels because they're renewable energy. Even though they are actually trying to ramp up their build up of the renewables, but the power grid in European market is still not that mature yet, because they're trying to connect between countries. So they could take decades. So at this moment, their reliance on these fossils and this global highly traded commodity is still very, very high. So we do see European might suffer, might be more vulnerable to this kind of attack as compared to Asian countries.
I see.
Yeah.
Yep. So there you have it, Miss Ashley. This is our explanation from our research team. Okay, so since we have a very limited time right here, so and again just now I believe that we have actually addressed the Malaysian market as well. So right now we do have a very positive view coming from the our Prime Minister Anwar. The new policies, they have been bringing in a lot of these multi companies coming into our country, right? So definitely we will see some improvement, some performance from the Malaysian market, right? So I believe that's the most of the questions that we will be addressing today. But no worry, if let's say we actually miss out any of your questions here, we will actually prepare some answers, and then we will actually post it out to you guys, and then we will have an article to explain about it. So yes, correct.
Yes, maybe I mean just now, given all of this, the entire webinar, and then our major some of the views already lined up. So maybe just a summary, like just now one of the question, what are the markets are attractive now?
The most
So
attractive.
yeah, if you look at our FSM website, right, we have a dedicated place where you can see all the star ratings for respective markets. So currently sitting at 4 stars, which is the highest rank as of current, is actually Japan markets, digital economy, Singapore as well as Korea. So what
Sorry, just to stop you a little bit here, over here. Perhaps I can actually share it from my screen here,
sure.
just so that our viewers can actually know where they can navigate towards the the star rating, the recommended fund list. Yeah. All right.
Yeah. So I think it's a good way.
Yeah. So as you guys can see right here is actually the FSMOne mobile applications. So we do have a lot of features over here that can assist you to filter out, to select the right funds for yourself. So you can just simply go to this fund buttons, and then right here there's actually the recommended fund list. Yep. So these are actually the funds that are being selected, being filtered by our research team. So they have actually filtered out some of the best performing funds based on their historical performance and also the methodology, right? Yeah, so these are actually some of the fund lists that you can actually refer to. And then also if let's say you're actually looking for some of the Asia x Japan funds, so these are some of the options that you can actually look into it. And then also we do have some core portfolios here, which means that you can actually hold for a longer duration, meaning to say you can even hold up to like 5 to 10 years. And also we do have some supplementary portfolio, which means that it will be more on the tactical play, it's more of a short-term play based on the market movement. And usually the supplementary one is the one who deliver better returns, right? And also the private retirement scheme, PRS funds, also we do have some filtered recommended funds for you. It make it easier for you to choose from the list, from the sea, from the ocean of the unit trust funds. And also the things that Jane has just mentioned, right, is that the star rating. So you can actually see it from the page over there. There's a button, there's a feature where you can click in and then it will show all the star ratings for different countries and sectors as well. Like Jin has mentioned just now, Japan is one of the very attractive one, 4 stars coming in. South Korea, Singapore, and the digital economy, they are also at rating at 4 stars right now. Yeah.
Yeah, so the common ground among these 4 stars is that they actually ride on the semiconductor upcycle. So we actually upgraded some of the markets early of the year. So stay tuned for our next year key investment team, where we might actually come up with a change of stance, or we actually reaffirm our positive view on selected sectors.
New investment opportunities also,
yeah,
right?
New investment opportunity. So over here, you may notice that Malaysia or some of the ASEAN countries actually sitting at attractive level as well. However, you may also be aware of some of the risk possibility, because the markets actually evolve over time. It doesn't mean that we actually label here US as attractive. It will be like deliver a super strong returns throughout the year. So you should also be aware of some of the downside of this sector, which in nature US itself has a lot of global. Actually garners a lot of global investors.
Yes.
Hence the funds flow is pretty fast as compared to the rest of the Asian countries. Hence you should be aware of these key risks as well.
Yes, correct. So when we are building out a portfolio, this is actually something that we can actually refer to. And then also based on the risk profile that you have, because each of us we have our own risk profile here. So it's also a very important element when you are building up your portfolio, a resilient portfolio. And also there's another feature that we like to recommend to our viewers here, is that we have this funds and ETF selector, and also we do have a few presets over here, which is also prepared by our research team here. So if let's say you are looking for some semiconductor funds or like ETF, you can straight away click onto the presets, and then these are the funds that it will be showing to you, where they are actually investing in semiconductors. So same goes to the others. Same goes to the other sectors or like any other specific country like the Japan, Singapore, or even the recommended fund as well. So it will make it a lot more easier for you to filter out the right funds to put into your portfolio. Okay. Yeah, I think that's about it. So before we actually wrap up the session here, right, there's something that I would like to promote a little bit. So a little bit of ad session here, just to promote some of our new campaign coming in. So yeah, so the first campaign that we are gonna promote today is actually our Asia Fund campaigns. So the campaign will actually runs from 9th of September until 25th of October. So if you are investing into any of our recommended Asian funds, right, for every 1,000 ringgit that you are invested in, you will be getting 10 ringgit bonus units. And similarly, if you are investing 100,000 into it, you will be getting a 1,000 ringgit worth of bonus units. All right. So for the list of the funds and also for more details about the campaign, you can actually scan the QR code over there. All right. And then also you can actually go to our FSMOne Malaysian website, and the first pop-up will be the Asian campaign right here. And then the second thing is, it's the end of the year, year 2024, and also it's the time where we need to look into our tax relief measures, right?
Tax benefits, yeah.
Yeah, it's also one of the benefits that you can get from, for the tax relief benefit basically. So we do have this PRS campaign going on right now. If let's say you are investing 3,000 into the selected private retirement scheme funds, you can actually entitle 40 ringgit MYR cash account credits into your FSM investment accounts. So the campaign will actually start on the 1st of October until 15th of December year 2024. And also for more information, you can actually go to our website, FSMOne Malaysia, and then you can find it from there. All right. So also again, if there's any inquiry or any information that you wish to check with us, or you wanted to get some more information from our research team over here, you can actually reach out to us via live chat, or you can send us an email at investhelp.my@fundsupport.com. Okay, so
yeah, I mean also to add on, if any of the investors find this session interesting, right, kindly just give us feedback, say you like it, and we will try to have a second episode soon. Yeah.
Yep, second episode, Ask Me Anything with research team, maybe with the portfolio management team, or any respective department that you wish to talk to. We can try our best to arrange it. Yeah, so just feel free to let us know if you like this. If you like this session, you can just give us a like, a thumbs up, or you can just leave a comment for us. It will be very encouraging for us as well.
Yeah, I think in short, you may find your sweet spots in certain markets. For instance, right here, what we have already highlighted, those beneficial semiconductor upcycle, as well as the AI rally that is taking place in certain markets. So these are some of the sweet spots, but the most important when you are actually going through a rather volatile and an event-packed end of year, right? Maybe you should practice your risk management well at this moment of time, whereby you should actually do your proper research as well as practice diversification. So that will actually help you navigate through the last leg of 2024.
Yes, correct. But no worries, if you have any challenges on building up your portfolio, no worries, always reach out to us. We are always ready to help. All right. So again, we appreciate your time, and then appreciate you tuning in and also join us in this discussion. So I hope that this session will be useful, will be insightful for you to build a portfolio, to set up your investment strategy for next year, and it will be a lot easier for you to generate some profit, because that's the main goal, right? All right. So if you have any questions, always reach out to us through live chat or email, no worries, and we are always happy to help. So, all right, this is Sid Hong, Jane, and Alvin. We're signing out. Good night.
Good night.
Thank you.
Thank you guys for tuning in.